Hey everyone, this upcoming week in the markets is going to be one of the biggest, craziest weeks we've had in a while. So I just wanted to take some time at the beginning of the week to go day by day and talk about some of the key earnings reports that I see throughout the week and go into their valuations, their earnings estimates, and just my thoughts on each of these companies. Now, if you like this type of content, be sure to subscribe to the channel, give this video a big thumbs up, and would really appreciate any comments or thoughts you have on any of these companies in the comment section as well. So we're going to start on Monday, and there's lots of companies reporting, but unfortunately, given the amount reporting this week, I can't really get into all of them. So some of the ones I'm going to be looking at on Monday is primarily going to be Charles Schwab. Charles Schwab is obviously a US brokerage, huge company, $90 billion market cap. This company has been trading down behind some of the things happening with the broader banking crisis and what happened with Silicon Valley Bank, as they also have lots of long-term treasuries and things like that they have deposits invested in. But it seems like it's a bit of a different story, a bit of a different rhetoric. So I want to go through this one a bit. Currently down 38% on the year, once again, primarily driven by that huge drop once the banking crisis happened. But with that being said, the CEO of the company is saying that they have actually seen significant inflows given some of the concern on more regional players. And at the end of the day, the entire banking structure is really a confidence game. So as long as people don't all rush to take their money out at once, all of these institutions will be fine. It's just when that happens, they get in challenging situations. So even if they have loans that are far out in terms of how they invested their money, as long as they're having flat or inflows versus significant outflows, they should be fine. And I think the reason they're having inflows, even though they're in a similar situation, is just because of the size of the company. People think they're too big to fail. They can raise money, whatever it may be. I think there's safety in size. And that's why this company's had a very different fate in terms of consumer reaction versus a Silicon Valley Bank or some of the other ones. With that being said, not everyone wants to go around for the ride with this stock. So a top investor in Charles Schwab sold their entire stake just as they feared some crossover in all the banking turmoil may impact Charles Schwab based off of how their loans are, not their loans rather, but how their deposit interest investment strategy is currently mapped out. So some people are saying, screw this, I'll take the loss, I'm gone. But it seems like from an operational standpoint, deposits are still healthy. From an earnings estimate standpoint, people are expecting this quarter to do about 90 cents in earnings per share. So we'll see how that pans out. Overall, they're expected to do about $3.70 on the year. I will acknowledge it's a very wide range between low side and high side analysts on this one. But let's just take the median, 370 this year, 450 next year. The stock's at $50. So even at next year earnings, they're still trading 11 to 12 times 2024 earnings. I feel like in the banking space, there's lots of good options that trade for 10 times or less current year earnings. So I'm not sure why this space is trading at a premium, but that's just my initial thought on the company. I'm also somewhat invested in this company through my TD Bank position because they actually own a percentage of Charles Schwab from their merger that they all had with TD Ameritrade. So that's another reason I'm interested to see how this stock does. I'm just mostly looking for them to reaffirm confidence of inflows and that operationally everything's going well. No one's really taking out money in droves, but we'll see what happens there on Monday. On Tuesday, we got a lot more going on. So the main ones that I will be looking at is Johnson & Johnson, who's reporting before the bell. They have a lot going on, which we'll go through. Netflix, it's going to be a really interesting quarter for Netflix. And then lastly, First Horizon Corporation, given just the bank's position as a regional bank and also a pending acquisition with TD Bank. Okay, going into J&J first. So J&J currently trading at $165 a share. Their year to date is down 7%. Their 1 year is down 7%. So they've had a lot going on in this company. It recently rallied behind not an acquisition, but a lawsuit settlement on baby powder that was $9 billion. This is a huge settlement. Obviously, $9 billion. You can like buy a company with that much money, let alone have a lawsuit for that much. So, despite a $9 billion settlement, we saw the stock rally 7% off of it as people just don't like uncertainty in the stock market. So that was interesting to see, but should be a pretty big hit to earnings in the short term. The other thing, and one of the reasons why that settlement was important, is they're still working on their spinoff for their consumer products division. So think about products like baby powder, obviously, but also like Tylenol and lots of other products that Johnson & Johnson owns for the end consumer. They're looking at spinning that off. So once that spinoff happens, they're hoping a lot of value gets created from having a pharmaceutical and medical division, and then also a separate company where they hold the consumer products. So we'll see how all of that pans out. Maybe they'll give more information on that on the call as well. In terms of the analyst expectations, we're at about 10.50 earnings per share this year, 2.50 on the quarter. So we'll see how they do versus the quarter and how they guide for the remainder of the year. But if I just take the current estimates, this company's trading at about a 15 times multiple, which honestly doesn't seem that bad for the type of company you're buying here. Huge global exposure, big healthcare exposure. As long as their pharmaceutical division's positioned for success and doesn't have any huge patents coming up, this may be one that I may want to add to the watch list at a 2.7% starting yield. I don't really love this huge increase that recently just happened, especially over a $9 billion settlement. So I'm going to see how this pans out. May wait to see how they report this quarter. But overall, this company seems pretty interesting from a valuation standpoint. The next one is Netflix. So Netflix has been on a wild ride, up 15% this year, flat over the last year, and just over the last 5, you can kind of just see went all the way up to almost $700 a share, and then down to like 150, and now it's doubled since there. So a bit all over the place, to say the least. In terms of what to expect, so analysts are expecting about $7.9 or $8 billion in revenue for the quarter. That would be growth of about 6%. But I think people are still fixated on subscribers to a certain degree. It looks like they have guided to about 1 million subscriber growth user growth in the quarter, which would be good to see them continuing to grow, even though that's relatively small on a base of over 200 million. But just nice to get back to consistent growth on the subscriber front. They're trying to move attention away from subscribers towards revenue and earnings growth as that part of their business has become more and more developed. But I think investors will still be pretty fixated on what they report from a subscriber front. So that'll be an important metric to see them report on Tuesday. From an earnings perspective, everyone's expecting about $3 earnings per share and about $11.50 on the year. So if I just take $11.50 on the year and closer to $15 for next year, $11.50, this company's trading about 30 times earnings, high 20s. And if they deliver, subscriber growth, revenue growth, profitability growth, that's probably not a crazy multiple for them to be trading at. The other thing that will be interesting to see what they report on is the password sharing project that they're doing right now with not letting people sign in on the same account for multiple locations. It'll be interesting to see if they lost subscribers behind that or gained subscribers behind new signups, and how that's all playing out as well. Sorry, I keep choking on my words a bit today. And lastly, just First Horizon quickly. This bank has a deal in place with TD Bank to be acquired for about $13 billion, currently trading 35% below that. Has gotten hit over the last couple months because of the banking crisis that happened on regional banks. They were not immune to that since they are a regional bank themselves. and that casted a lot of doubt over the acquisition as well. So if you look just at First Horizon Bank, don't even type TD in, the entire company or stock is being reported on in the likes of if they're able to close the TD deal. So there's regulatory hurdles. There's also worry that TD may want to try to get them for a lower price given everything that's taken place in the banking sector since they first announced the deal. So a lot going on. The company can potentially not have the deal go through at all. The company can potentially get sold for cheaper, or the company could potentially get sold for the full amount. So I'll be watching this closely and seeing what they say in their earnings, just because I am a big TD Bank shareholder. So I may end up owning this company in the next 6 months. In terms of if they don't get acquired and just what the fundamentals of their business are, analysts are expecting 50 cents of EPS this quarter, about $2 on the year. The stock's trading at $18.30, so they're trading at about 9 times earnings for this year, and then next year about 2.1. The high side forecast is $2.50 for next year, which would have this stock at like 7.5 to 8 times earnings. So more in line with banks, but a bit of a discount versus the larger banks that trade around 10 times earnings. So we'll see how this one plays out. It'll be interesting. The next day on Wednesday, there's a lot going on Wednesday. See Ally Bank, Abbott, more of a pharma company. The NASDAQ is reporting. Morgan Stanley. I've reported on JP Morgan in my earnings breakdown for last week, so I'm not looking too much at big U.S. banks this week, but definitely a lot going on there on Wednesday for you guys who may want to look at some of these other large companies. IBM's another one that could be interesting to hear from, but the one that I'm just going to take a peek at is Tesla. I'm not a Tesla shareholder, but it's just such a big stock in the stock market that it can swing the NASDAQ, it can swing other tech companies. So taking a look at Tesla stock here, year to date, up over 70%, but in the 1 year, they're down 45%. So that's just really striking to see how much they must have went down in the back half of last year to be almost up double this year, still cut in half, especially for the size of this company. You usually don't see $600 billion companies move 70% up, 50% down like this. It's pretty crazy, but that's what you're getting yourself into when you buy this stock. Just in terms of a quick earnings check, they're expected to do about $4 in EPS this year. So that is about a 45, 46 multiple. And then on next year, $5.50, that's closer to 34 multiple. So, everyone has their own opinion on Tesla. I'm just not close enough to the ancillary aspects of their business with humanoids and energy and solar and so on and so on. And just like Elon Musk's exposure overall and what he's doing with Twitter. So this is just one like that I don't touch. Not that it's a bad investment necessarily. I just don't care to look into it that much, and it's just enough other opportunities that I understand better in the market that are simpler as an investor, so I stay away from Tesla in general. But let me know your thoughts on Tesla if any of you guys hold the stock. The thing about the stock market is there's thousands of stocks out there, so if you don't understand a company or you just aren't comfortable with like a CEO or certain dynamics or price to earnings, like you don't have to swing on every 2 or 3 stocks. You can say no to 100 stocks before picking one that you're comfortable with, you understand, and meets your objectives as an investor. So this is just one that doesn't do that for me. So I haven't ever been a Tesla shareholder, but still interested to see what earnings they put up this week for sure. Okay, going into Thursday. Thursday, similar to Wednesday, lots of earnings here. You have Taiwan Semiconductors. You have CSX, a big railroad. That would be interesting. I may take a peek at that one. Union Pacific, another railroad here. AT&T, which I actually just saw now. I'll definitely be looking at this one because I do own some AT&T shares. But the other one that I'm going to be looking at is American Express. American Express is a $120 billion company, and it's been interesting so far over the last couple of months. The stock's pretty flat, but Visa and MasterCard have really ripped up. And I know they have different business models with Visa, MasterCard having stronger partnerships with banks, American Express being like their own filling house essentially. But this company trades significantly cheaper than MasterCard and Visa. You can look at their earnings per share estimate of $11 this year, $12.50 next year, $2.60 on the quarter. So we'll see how they come in versus this estimate. But even on the 1 year at $11, this company's trading at about 15 times earnings. And then for next year, closer to 14 times earnings. So below the category, or sorry, below the market in terms of a PE earnings. Not sure if that they fear that corporate spending is going to go down with a recession or whatnot, but this is definitely a company that's at a very reasonable price to earnings ratio, in my opinion, for the moat that they have and the business that they've built. So going to definitely see what earnings they post and how the stock moves off of that. And then just to do AT&T briefly, AT&T is a stock trading under $20, and their earnings per share estimate, I believe, is about $2.50 on the year. We're going to just do it quick. So this is a stock that I own. I don't own a ton of it, but I think it's a cheap stock for the type of business that they operate in. It's not high growth, but it should be relatively consistent over time. Yeah, expecting about $2.50 a share. So I'll buy AT&T at 8 times earnings and get a cash flow yield over 10% while getting paid out a 6 to 7% dividend, and they're reducing debt, buying back shares. So I don't know where this business is going to be in 10 or 20 years necessarily, but I think their opportunity to return cash to shareholders, given the price of the share price today, is attractive. So that's why I have a small to medium-sized position in this stock. So I'll definitely be looking forward to seeing what earnings they post. And the last stock on Friday, a bit less going on Friday. You have SAP over here. The stock that I own that I'll be looking at is P&G. So Procter & Gamble has really run up over the last few months, 6 months, up almost 20% at $150. This company's paying a 2.5% dividend yield. Something that's worth noting is they've been increasing prices a lot, it seems, and they've kind of said in their last investor report that they fear it's going to be more and more challenging to continue to increase prices over time. So that's just a watch out. They've kind of protected their earnings with pricing power. Will they be able to continue doing that, or are they going to start getting more pushback? In terms of EPS, they're expected to do a bit under $6 this year, a bit over $6 next year. So just on a price to earnings ratio, this company's trading at like 25 times 2024 earnings. So very expensive company from just a stock valuation perspective, in my opinion. But on these companies like P&G, Coca-Cola, stuff like that, they tend to have these multiples for a reason, because they've proven over the last 100 years that they can withstand these situations. They can create shareholder value long term. So I know it's tough biting the bullet to get into some of these types of stocks, but may fit a role in your portfolio depending on what you're looking for. So I'll try to keep it brief and to that, but it's going to be a really exciting week in the stock market. In addition to what I kind of went through a bit more in-depthly, we have a lot of banking earnings, M&T Bank and other types of businesses, Bank of America up there as well. So we're going to kind of see the rhetoric and the narrative around the recent banking crisis unfold this week. Hopefully it's all behind us. We don't see significant outflows at many of these banks, but everyone, or lots of people, including like Warren Buffett, have said they don't feel like it's over as interest rates stay so high and whatnot. So that'll be a really interesting theme throughout the week to see how things play out. We also start to get some tech earnings like Netflix and other things. So it'll be interesting to see how the mega cap tech companies like Apple, Google, Microsoft, Amazon trade or adjust based off of what tech earnings and like Netflix do. So lots going on. Should be a really exciting week. Be sure to stay close to the channel as we go over some of the earnings as they unfold and me breaking them down at the end of the week. But that's all for this video. If you like this type of content, be sure to subscribe to the channel. Give me a big thumbs up on this video. I'd really appreciate it, and would love to hear from you guys in the comments. See you guys in the next one.